Congratulations to Chris Carter on being named an Oil and Gas Investor 30 Under 40 leader.
We're with Chris Carter. He's 36 years old and he's a managing partner of Natural Gas Partners. Welcome, Chris.
Thank you.
How did you get started with NGP?
Yeah, so I was working in Houston for Deutsche Bank in their energy investment banking group as an analyst and spent 2 years there from 2002 to 2004. And a friend of mine told me about NGP. He had a friend who worked with the firm. And at the time, energy private equity was still much smaller than it is today. Many of the firms today that are managing $10, $15 billion still had funds that were less than $1 billion at the time. So as I got to learn a little bit more about energy private equity and the opportunities, it was something that was really exciting to me. And ultimately I had the chance to go to Irving and meet several of the investment professionals at NGP and learn more about their business. And my final interview was actually at NAPE with Ken Hirsch, our CEO, and he told me about where the firm had come from, its history, many of the portfolio companies, and his vision for the firm, and it was something that I got very excited about. And fortunately, in 2004, was offered the opportunity to start with the firm.
Part of your job, you were responsible for sourcing and evaluating new investment opportunities. Has your strategy changed since the downturn?
You know, I wouldn't say that our strategy has changed. NGP's been in business since 1988, so as a firm, we've been through several of the cycles. So what we're going through right now isn't new to the firm. Our strategy continues to be partner with great management teams and follow them to acquire assets that have high rate of return potential and build great companies. And that's really the same. I think what the down cycle does is really just sharpens the focus on what type of assets you can buy and develop that can really increase value in a lower price environment. We're spending a lot of time right now really evaluating single well returns of drilling programs and ensuring that the assets that we're acquiring can continue to generate positive returns in a lower for longer price environment. I would say it also really sharpens the focus on term acreage versus held by production acreage, and also balance sheet management, and making sure that companies have the ability to grow and continue to build companies in a lower commodity price environment.